In this week's video, we'll review the latest charts and data to help us answer the million-dollar question. Is the stock market bottom in place, or are much lower lows ahead? We've got a lot to cover. We'll be moving quickly, so feel free to use the pause button on your video player. This is a daily chart of the volatility index, affectionately known as the VIX. We covered this chart and a study in the March 6th video 2020. In that study, we made it a point to say that the study was based on after the VIX peaked. And in the 2020 case, it did not peak and it continued to rise, and thus we learned something. From the look on March 6th here to the look this week, we basically morphed into an extremely rare look, very, very similar to the look here in calendar year 2008. How rare? Well, we only have data for the quote-unquote new VIX going back to 1990, and as you can see, the VIX has only been elevated at these levels one other time, and that was October of 2008. And by definition, the standard VIX speaks to volatility expectations looking out 30 days. And this look here tells us that present-day volatility expectations looking out 30 days have only been this high one other time in October of 2008. And we know from past videos that looking at the rate of change, in this case the 10-week rate of change for the VIX, can be helpful in terms of understanding when volatility expectations start to wane. This is calendar year 1998. This is the VIX here. This is the 10-week rate of change. The S&P 500 makes a low here at the end of August 1998, but you can see the VIX is still elevated here, and the rate of change moves above 80% here. Then when the VIX starts to wane, that's volatility expectations waning, and the rate of change starts to fall and eventually comes back down below 10% here. Here's the rate of change at the initial low. Here's the rate of change waning at the retest here where my cursor is. That's the S&P 500. Similar situation in the 2011 case. Upper left-hand corner is the S&P 500. I've highlighted the bar here. This is the plunge low here in August. You can see the plunge low, the rate of change for the VIX is still rising. The final low, which is a retest low, the rate of change for the VIX starts to wane. And we alluded to these concepts earlier this week on Twitter. It is not unusual for the first low to occur during somewhat of a max fear situation where the VIX is still elevated. Then the market comes back on the retest, and in this case makes a lower low. But that happens at a lower rate of fear, and the VIX is waning and the rate of change for the VIX is waning. Experience says we can learn a lot about markets by studying the concept of rate of change, and thus we've been doing a tremendous amount of work behind the scenes over the last 7 to 10 days or so. These are what we call CCM VIX rate of change heat maps. Kind of envision it this way. The rate of change is rising here and waning here. In our heat maps, red would be rising, green would be waning, yellow would be waning. The red areas in the heat map, you can somewhat think of them as maximum fear. And then as we move out of maximum fear here, walking forward, you can see fear starts to wane. Inside of this spreadsheet, these are dates going across, so the dates are going down, so you're walking forward from the top to the bottom, and you can see how volatility expectations change over time via the heat map. This would be the least concerning look relative to the VIX. This would be the most concerning look. What are we looking at? We're looking at 3 periods. October 9th, 2008, March 9th, 2009, and March 26, 2020. This is March 9th of 2009, right in here. And conceptually, that would be similar to this type of look here where your rate of change is waning And in this case, you make a retest with lower fear relative to the max fear period. And if we label 2 out of the 3, this period right in here is October 9th of 2008, telling us that the only thing left is March 26th of 2020. It's pretty fair to say that this is maximum fear. There's more fear and concern about future volatility in this look here than there was even during the height of the financial crisis. Let's match this up on a chart so you can understand the concepts a little bit better. If we look at this period here on a chart, you can see when the stock market is falling, top part of this on the right is the stock market where my cursor is. Stock market is plunging here, sound familiar? And the VIX is spiking, sound familiar? And then the stock market comes down in the spring of 2009, and this is a form of a retest. It just happens to come in the form of a much lower low, but this is a retest of this initial low. The first low occurs in here with maximum fear. The second low, even though it's substantially lower than this period here, occurs at a much lower rate of fear or concern about future volatility. So everything that we're seeing on this slide conceptually is identical to this period here in 2011. The stock market makes its first low in August. The VIX is rising. This is your maximum fear period where your rate of change is rising. Even though we make a lower low here in October, volatility expectations are waning, and this is your lower fear period. We built volatility heat maps for every single day that we have data for in the VIX going back to 1990. This is the highest amount of red that you will find in any case. Even if we use the old VIX and go back even further, there's only 2 cases that look similar to the present day, 2008 and 1987. The present day looks worse than both of those cases. And in both cases, this look here in 2008 and the similar look using the old methodology VIX in 1987, in both cases, when we had this type of look, the S&P 500 was not at its final low. And conceptually, we have to keep in mind, March 26th, the VIX is still at a level that was only seen one other time, dating back to 1990. And this is telling you that volatility expectations looking out 30 days are basically the same they were in this period. Right up in here now, if we draw a line down, this is October of 2008. The low doesn't come until March of 2009, and it comes at substantially lower levels. Clients and regular viewers know that we've used similar concepts with the 10-week rate of change for the S&P 500. We said the 1987 case is similar to the present day. Similar concepts here. You can see the 10-week rate of change here on the first max fear plunge in 1987 is down near negative 30. When you get this retest look here and this sideways movement here, the rate of change starts to wane a little bit, telling us that from an entry perspective, it's a little bit safer from a probability perspective to enter here than it was here. Down here, we're below -9. Here, we're able to make it back where our rate of change hits this -5 level here. Nothing definitive about this. It simply speaks to probabilities. How does the same chart look in the present day? Are we down here in the maximum fear look? Or are we back into more of a tame, it's safer to get back in the water, lower volatility look, similar to this point here, late in 1987, in December of 87, and if you know your market history, the lowest low is printed in early December 1987, and then really good things happen in the stock market. This is the look of the present day chart, the same 10-week rate of change for the S&P 500, Thursday, March 26, 2020, and you can see at this point, Our 10-week rate of change is really nowhere near that -5 line yet. This is telling you something very, very similar to the rate of change look on the VIX in the present day, which looks a lot more like October of 2008 and really doesn't look anything, not even remotely close to the look of the rate of change for the VIX right here on March 9th, 2009, when the S&P 500 bottoms. None of this predicts anything. It simply speaks to probabilities. It's good to keep in mind on March 6th, when we did the original volatility analysis or study, this is what the VIX looked like. We're not really in this territory at all here. But in that video, we made sure that we noted in this case here, and we did it with this slide. We said there was a nice counter trend rally, but then we said that was all wiped out, all given back, and then some, and the market went on to make lower lows. This is October of 2008. This is a counter trend rally, and this is the same period that we've been talking about in this week's video. October of 2008, our max fear look, we get a counter trend rally, but then the market goes on to make a much lower low. And relative to this look in here, from this point in here, the S&P 500 dropped 25.64% before reaching the low on March 9th of 2009. This 25% is the move from here in October of 2008 at this point of max fear to the lower fear low that occurred on March 9th of 2009. This still high rate of change look on the VIX that's similar to this high rate of change look on the VIX tells us to be open to a much lower low. Is there anything else that tells us in the present day to be open to lower lows? Yes, this chart here is dated Friday, March 20th. It's a week ago, March 20th, 2020. You can see down here, we talked about this before. This is weekly RSI. You can see it's clearly below 30 here after being above for quite some time. So this is the first look like this that we've seen really since 2008. You drop a little bit below here in 2011. Going back to 1971, the only times we've had a similar look, 1974, 1981, 1987, the first drop in 2001, a drop in 2008, and a slight drop here in 2011. Therefore, it might be helpful to know last week on the 20th was the first time we closed below 30 with this look. What happened? A similar instance here with the first close below and in every single case. We'll start here and work our way forward. Every case is going to be the same. Friday, August 2nd, 1974, you can see RSI closes below 30 for the first time, and that is similar to March 20th, 2020, where we did the same thing. Here's the look in 74. This is the look September 25th, 1981. In the 1987 case, we go considerably below 30, but the first time we close below it on a weekly basis is Friday, October 23rd, 1987. And this look here would be similar to March 20th of 2020. Here's our 1987 case. It doesn't happen anywhere again until the first drop below in calendar year 2001 happened on March 16th, 2001, which would be similar to March 20th of 2020. And remember, we're looking for the first drop below, not this one, the first drop. Here's the first drop below after being above for several years. In calendar year 2008, this would be similar to March 20th. It happened on October 3rd, 2008. See, RSI here drops below 30 on August 19th, 2011. And here's our similar look on March 20th, 2020. Therefore, it might be helpful to know what happened in each case walking forward in the stock market. Starting with 1974. August 2nd, 1974, this is the first weekly close with RSI below 30, similar to March 20th of 2020. There was a sharp 5% rally, short-lived, fully retraced. The loss from here in 1974 to this point here, 20.75%. Let's look at the 1981 case. Did get a sharp counter trend rally, 12%, but then you ended up falling 18.95% after the counter trend move. And this point here is 9.19% below the day that's similar to March 20th of 2020. Now let's look at the 1987 case. This is the first weekly close where RSI is below 30. It happened on October 23rd, 1987. From that close on the weekly chart, this is a daily chart, the low didn't come till 9.79% below this look in here in October. This is your initial low, and this is your retest. Let's look at the 2001 case, the first drop, RSI below 30, happened on March 16th, 2001. We eventually did get a 14% counter trend move here. It was fully retraced. From this point here, the S&P 500 lost 40.83%. From this look here, which is similar to March 20th of 2020, 32.49%. The moral of the story thus far is, in every case we've covered, when you get a look like this, thus far it was not over in terms of the pain. How about the 2008 case? Weekly RSI dropped below 30 on the S&P 500 chart for the first time on Friday, October 4th, 2008. Here's the S&P 500 here. Was it over? No, you fell almost 40% from this look here, which is similar to the look that we had on March 20th of 2020. In October of 2008 should spark some very, very recent memories. We just covered October of 2008 with the heat maps. Now we have something else that ties the present day to October of 2008. 2011 case, first weekly RSI close below 30 came on August 19, 2011. Was it over yet? No. A lot of volatility, big pop, give back, a pop, and then a lower low on the retest. This is 2% lower than August 19, 2011. So let's summarize the cases. In the cases similar to March 20th, 2020, the median additional loss before making the final low was 15.27%. Every case, without fail, printed a lower low, and the low came between 42 and 572 calendar days later. That would be similar to walking forward from March 20th of 2020. The median number of calendar days to the low was 110 calendar days. Simply telling us to keep an open mind about either a retest or much lower lows. Given the Dow rallied 20% in 3 days this week, a couple of fair questions. Was there observable improvement in some of the data tracked by the model? Yes. Is it unusual to see that type of improvement within the context of a downtrend and/or bear market? From Sentiment Trader, an example of real-world improvement. 57% of S&P 500 stocks have triggered a MACD buy signal, something that's happened numerous times near many historic bottoms. If you look closely at this chart of the S&P 500, one of those periods is basically October of 2008. Even in the context of this type of fear in the VIX, some really, really good things happened in 2008 within the context of a bear market. And if you look closely in many of these cases, they did occur near historic bottoms, but we have to remember that a bottom can be a process. You're not at the bottom here, you're not at the bottom here, you're not at the bottom here, and you're not at the bottom here. This is the title slide from the February 28th, 2020 video. Clients and regular viewers know prior to that video, we had a very bullish outlook based on the evidence in hand, but we always preach maximum flexibility. When the evidence changed, Before the market opened on Monday, February 24th, we basically said that we were going to start implementing bird strike procedures to protect profits. And we know from past videos that we just experienced the fastest 10% correction in stock market history, the fastest 18% drawdown in history, and the fastest 20% or bear market drawdown in history. Thus, a logical question might be, was bird strike particularly helpful? The lowest low that we've made thus far in this move was as of Monday's close. At the low, the S&P 500 was down 30.75% year to date. The Dow was down 34.85% year to date. The CCM market model was down 13.89%. This is a real-world return based on an actual client account, an account that executes all of the trades recommended by the model. Why would we consider protecting capital during the fastest 30% drawdown in stock market history? Because we can't assume at this point that we've made the final low. So quickly, let's just revisit some of the examples to help us answer this question. How far could the stock market drop based on history? This is the low earlier this week. This was the peak February 19th, 2020. Every horizontal line on the charts that follow represents a real-world pullback in the stock market. So for example, if we had this similar peak-to-trough decline in the S&P 500 that was experienced in 1987, this is what it would look like, and this is where we would bottom, where the blue line is. Keep in mind, every single one of these lines is based on something that's actually happened in the stock market in the past. If we had a drawdown similar to what investors experienced after the dot-com bubble burst, we would fall to this silver line here. Financial crisis down to the black line here below 1,500 hypothetically on the S&P 500. Right now we're still above 2,200. The 1937 case, the drawdown would take us between 1,400 and 1,300 hypothetically. And the 1929 case tells us why we can't assume in the present day that it's already over. In every single one of these historical cases, the market fell quite a bit further from where we are now hypothetically before finding a major bottom. Our focus in the present day has to be on current clients and the markets, especially until things calm down. If you want some assistance and are confident you're ready to go, you can find this FAQ on our website. And if you know you're ready to go, don't have any questions, you can find this FAQ, and if you're a do-it-yourselfer, you can make it happen on your own. This slide and the one that follows has a little bit of information on the virus. You can pause your video player, and you can pause your video player to read this text from the Wall Street Journal. We know that the October 9th, 2008 case made a much lower low. Similar concepts here with rallies and then lower lows, Nautilus Research. It's the present day case earlier, 1929. You fall 35%, rally 18%, and then you fall an additional 26%. This is your retest making a lower low. The 26% drop is from this point to this point. 1987 that we've covered, you have a 33% drop, you rally roughly 15%, and from that point, you lose 13.34 and have the retest of the low. On a closing basis, the low in early December is slightly lower than the low in October. In this case and in this case, this is part of a bottoming process. A bottoming process can include a much lower low. We always want to keep that flexible, unbiased, and open mind. From a bullish perspective, Sentiment Trader, for the past 3 sessions, a minimum of 80% of NYSE issues advanced, and 80% of the volume went into those issues. That happened twice before in the past 80 years. The first kicked off the mid-1980s bull market. The second kicked off the 2009 bull market. Flexible, unbiased, and open mind. Data tying the present day to 2002-2008. In both cases, the market went lower before finding the final bottom. There's a tremendous amount of stimulus coming into the system from the Federal Reserve and the bill that's being passed in Congress. That very well may cause an unnatural low or another V bottom. It's important to keep in mind. We had QE and a massive package known as TARP in 2008. Bloomberg expectations were high in October of 2008 based on Federal Reserve action and a bailout package from Congress. We already know bad things happened walking forward from October of 2008. Good things didn't happen until early March of 2009. We have to be careful with headlines like this. 100% of the counter-trend rallies in 2008 were fully retraced and then some. How do we know that? Because the market went lower for the first 2 months of 2009 and took out every single low from 2008. The big rally was not surprising. Before it happened, we said we could get a 10 to 20% pop. And the markets have fallen a long way, so we have to be open to redeploying our capital at a rapid rate when we see what we want to see. That may happen in a matter of days. It may happen 3 to 6 months down the road. It may happen more than a year down the road. Does the big 3-day pop mean really good things are going to happen? History says not necessarily. Twitter handle here. 15 best 3-day performance ever for the S&P 500 index. What happened walking forward? 1 week later, 1 month later, 3 months later, you were only positive 42% of the time. The average and the median gain all negative walking forward. As we noted on short takes weeks ago, you can get massive counter-trend moves within the context of a bear market. And in Carter's tweet here, notice how many of the dates in this table here. November 2008, October 2008, November 2008, 2008, 2008, 2008. The big move doesn't necessarily mean the low is in. That's to be determined. It's incredibly important that we take it day by day and look at the data that we have in front of us. We could be in the process of making a low now. It is possible that we've already made the low, and it's possible a lot more pain is coming down the road. In this case, the pain was relatively muted on the retest, and then really good things happened. Similar situation in 2011. The retest was a lower low, but relative to the original low, not that much more pain. Tweet from Thursday's session, which was the third day of the big 3-day rally. Volatility readings have not capitulated yet. At this point, still sending measured approach signal. That tweet was based on numerous volatility maps, 1 month versus 6 month volatility, stock versus bond rate of change heat map, bonds versus stocks, credit spreads, the VIX, which we covered, and then a derivative of that looking at 1 month versus 3 month volatility. And the message from all 6 cases on the screen was basically the same. If the market has already made a bottom, there is evidence that needs to change to confirm that. And the evidence that we have in hand right now does not point to a bottom already being in place as a high probability event. As always, we will head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.